From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, call it a recovery delayed, not derailed, leaving central bankers gearing up for key decisions as the market eats up monster bond supply. We begin with the big issue. December is the new September.
Post-Labor Day was the game plan, but
the Delta variant surging.
The Delta variant took off.
A whole bunch of things going on there.
There's some near-term substantial tightness.
Loss of benefits.
We don't have a handle on the pace of job creation.
The new school year is a bit of a wild card.
a lot of companies are starting to push back that back to office.
Major corporations have certainly pushed off their kind of full return to office.
We do expect the markets to pause here.
So much talk of a weakened market in September.
Real economic activity is getting a little bit weaker.
September is going to be a white knuckle event.
September is a really critical month. I mean, this is when the rubber meets the road.
Joining us now to discuss the wrap-up the week is Manulife's Francis Donald, Morgan Stanley's Brian Weinstein, and Zach Swabe of UBS. Francis, let's just start with you. We've built up September to be this big moment. September begins and it already feels like people are pushing things back to the end of the year. Do you agree?
Unfortunately, I was in the September taper camp, but we didn't get enough advanced warning from Powell. We have not seen a solid understanding of what's happening in job pace. Labor force participation rates still have this big question mark. And a lot of that high frequency data is showing that the pace of spending amongst the U.S. consumer is slowing. And then, of course, that big elephant in the room, Delta, what that's doing to the supply side of the economy is really profound. And we haven't had a supply side shock like this in decades. So big uncertainty, and the Fed, Powell, doesn't like to move in big uncertainty. So it's looking like a November, December taper.
Brian, this was meant to be the month that those supply constraints started to heal just a little bit more. Do you think they will now?
No, I think the Fed really wants to wait. I think they've been looking for excuses to wait, especially Chairman Powell. I think this is a great excuse. I think he's been pretty clear that the goal is to create more uncertainty on the upside. So why would you take away the punch bowl when there are all these things floating around on the downside? You wouldn't do it. So I think the Fed will continue to be patient. They want steeper yield curves, more inflation fears, and I think they'll get it, but I think they'll be patient.
Zach, build on that. Is December the new September?
December's 3 months away. I would say financial repression is certainly here to stay. After yesterday's meeting, the lady may not have tapered, but in the future, let's see. But financial repression supports credit markets, my markets, and any lower rated risk markets. So certainly the markets feel comfortable, and hence limited volatility, we think, in the last week. Even from the Delta vol, so comfortable going forward in the near term.
Message seems to be wait, and then we all start discussing this reflation trade once again. Do you lean in, lean out? Francis, you're really frustrated with that word reflation. So let me just wind you up a little bit. Why?
Well, I wouldn't say I'm frustrated. I just think that it's not the appropriate way to characterize the current environment. Maybe this is the old school textbook economist in me, but reflation is when growth and inflation are moving positively. It's positive for the economy. That is not the situation that we're walking into right now. What we're seeing is that any inflation that is now in the system, and particularly that surprises to the upside, is going to be damaging for growth. So we can be risk on, but reflation is not really the word that I would use. I would say we are in more of a stagflationary environment, not actual stagflation. And if you really want to have the bull case, then Goldilocks works too. But reflation era is behind us. Now we have to think a little bit more critically about what higher prices from here do. They're not going to be good news.
Brian, your response to that?
I think that's right. I think that there are some dangers to having higher yields and having steeper yield curves and having an inflation scare, right? You see it in the labor markets, right? I think that can get passed on to consumers and act as a tax. So it could certainly hurt growth. And certainly we believe that if yields move materially higher, it could hurt. In the interim, I think Goldilocks is a good way to look at it. If yields moved up 15 or 20 basis points, I think it would be great. People would buy more spread product, capture the yield, and we'd be fine. So it's a bit of a dangerous game. But I think that definition about reflation versus dangerous inflation is probably good. It's a good debate to have.
Brian, what are you settled on? 160, 170 on 10s?
Yeah, I think. Listen, I think 160, 170 is a great place to think about. We've been there. It wasn't painful. It wasn't that long ago. I think when we've been on before, and the inflation was at its peak in February or March. I think this is the trough, or maybe last month was. Growth will pick back up. The reflation theme will come back. So we'll go back to where we were, 160, 170. And I don't think that's a bad outcome in any way.
Francis, I know you think we've seen the highs. Does the data over the last few months reinforce that view?
Yes, it does. And not because we're in sort of a danger of a recession right now or that the cycle is over in the near term, but that most of the good news and the momentum behind this economy does seem to be slowing. And a big thing that's happening here is not the U.S. story. The U.S. is going extremely well. It's the rest of the world as we deal with that Delta impacts, particularly in Asia, how that's impacting global trade. That's going to make it very challenging. And Powell talked to some of the global disinflationary pressures at play. I think we may be overemphasizing things like used cars and the rise in prices and cost of living in the United States and not focusing enough on those global deflationary forces. But at the end of the day, 160 versus 140, I'm not going to change my entire asset allocation process off of that. I agree with the other guests here. I'm not sure that that's a material difference in outlook.
Well, let's explore the range of outcomes that we could get going into next year. This was from the team at Goldman on complacency in the market as a point of vulnerability. They make the following statement. Markets are pricing an unusually narrow range of future asset outcomes relative to the unusually high uncertainty around near-term economic data. We caught up with MUFG's George Concaves on this. Guys, take a listen to what he had to say.
We're starting to narrow down the potential outcomes and scenarios that are out there. We immediately collectively as an overall market have been dismissive of, well, of course we're going to decelerate. We can't grow at the pace we were in the first half. But now as that deceleration becomes more entrenched, I think, there's going to be some second thoughts around, are we double dipping at some point? The narrative gets very fuzzy. There's a lot of uncertainties and some that are known and some that are unknown.
Zach, can you weigh in on that? Are we narrowing down the range of outcomes perhaps a little bit too much?
Well, potentially. I mean, in respect to the previous gentleman, that simply to me means that if we do have this slowdown or a double dip potentially in whatever economy we're talking about, there certainly will be a reaction function from the central banks, which would just mean, more foot on the gas and juice in the punch bowl. So I don't necessarily think that that's a significant risk. 2018, we saw there the significant sell-off from Q4. And then in January, the very beginning of January, Jay Powell obviously put the foot on the gas again. But the risks in terms of the credit markets or fixed income markets outside of the taper risk, if we're moving away from faster growth into this slower regime, the tapering gets put off. Policy mistakes obviously are one of the most significant things we think about. Policy mistakes, A, from central banks, B, from government, probably only the US government. The Chinese policy changes, the macroprudential moves they're doing hasn't caused much of a ripple effect yet into other fixed income markets or equity markets for that very reason. So we can, maybe cross that off, and therefore there is a narrowing. COVID, it feels like that isn't necessarily significant unless we have another Delta Part 2 or Part 3. So we can certainly cross that off. So we're really going back to the reflation, supply chain issues, which companies win, which companies lose. And that's very difficult at the moment. We're finding it difficult to go through and sift through the answers. Quarterly earnings do give a lot of information, but the data every day is increasing about the reflation. So certainly lots of work from a bottom-up analytical perspective to do on companies we lend to or invest in that
Well, let's pick that apart, just the initial comments there, Zach, and build on it if we can. You ultimately said, and I think ultimately for a lot of people they agree, there's a risk of a policy error. Francis, put the economics hat on just for a moment. The world of economics is incredibly divided. If I ask one person if the labour market is tight or loose in America, I'll get a different answer to the next person. They could say tight based on where job openings are in America. They could say loose based on the employment to population ratio relative to where we were pre-pandemic. That's a pretty divided world looking at the same economic data, which could tee us up potentially for a policy error, a policy mistake, or get this market wrong-footed into next year. Francis, can you weigh in on that?
Sure. Well, certainly your economist guests are mirroring the division within the Federal Reserve, where clearly not in my career have I seen so many different voices here. I think Zach really hits the nail on the head here. The range of economic outcomes are very extreme. So, of course, you'll get more views if you go into one side of that picture. But I agree with Zach that the range of policy responses probably is more narrow than it has been historically. And while we do fear a policy mistake of rate hikes, this central bank, and particularly Powell, has been clear that they are going to be more cautious. So the tail risks around central banks are really on the dovish side across the entire board. And I think that's why this concept of range of outcomes is narrow, not because the economic outcomes are narrow. There is a vast array of possibilities, huge uncertainty, but because the range of policy outcomes in response to those data is probably more narrow than it has been historically.
Interesting point. Brian Weinstein, final word from you, please.
And I would throw in the infrastructure package. What's going to happen with that? Right, there could be a policy error in there. How is it funded? How are taxes going to be handled? So there's another way you can handle the disparity in the employment situation is to change the tax code and the debt ceiling, right? But I think at the end of the day, the market's digested those, and I agree. The outcomes are for now are not that drastic when you think about the markets. And so you get low volatility, you search for yield, you stay in a range, and it's not a bad outcome for the markets.
The market has digested a lot this week. We're going to build on that. Francis Donald, Brian Weinstein, Zach Swabe, sticking with us. Up next, the auction block. What a week of monster bond supply. And this market ate it all right up, every single bit of it. That conversation next. From New York, this is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block where we kick things off here in the United States, stateside, where government paper drew strong investor demand across 3s, 10s and 30-year Treasury auctions this week, leaving primary dealers with some of the lowest percentage takes on record. Elsewhere, the US junk bond market bouncing back from a slow start post-Labor Day, pricing more than $3 billion in new deals. And finally, what a week. Corporate America reviving the high-grade market in a $76 billion issuance spree. The borrowing blitz pushing volume over the $1 trillion mark for the year. We caught up with Morgan Stanley's Sri Sankaran on this a little bit earlier. This is what he had to say.
The resilience of the credit market, right? That's been a bit of a surprise for us. Look at credit markets. You did see like probably a couple of weeks of decompression, but by and large, the lowest quality cohorts have held in very well. I would say it's this combination of supply plus the more aggressive positioning and where valuations are. That's what calls us a bit more of a cautious tone rather than just the supply per se.
Back with us, I'm pleased to say, Francis Donald, Brian Weinstein, Zach Swabe. Zach, I want to come straight to you. The amount of supply we've taken down this week in US investment grade, what's the signal, the message you take away from that, Zach?
Yeah, I think on one hand it's a story, but on the other hand it's a non-story. So I've been thinking about this, John, because I know you've been focusing on it today. I think last time I came in, we referenced the amount of negative yielding debt out there in the global financial world, and it was negative 12 trillion. I just checked on the Bloomberg terminal today, it's negative 15 trillion. Huh. Right, so that means significantly more negative real rating, IG and obviously Govy debt, for example. So therefore, it's a non-story in the fact that markets can easily absorb, whether it's institutional, whether it's private bank markets, for example, can absorb all of this positive nominal yielding securities, especially in US IG. So similarly within the high yield market, record issuance expected up to 500 billion this year. Again, that's all being absorbed. It's very hard to actually get large allocations in deals, for example, from large managers themselves. So stability, I guess, is the only thing which we can see from this supply. However, fast forward 1 month, when we see probably the largest tail of issuance by the middle of October, there might be some marginal spread widening in various sectors that have seen massive issuance.
Zach, do you see the same story in Europe, a similar story to the one we've experienced here in the United States?
Yeah, a very similar story in respect to the financial repression in Europe's probably worse. We have obviously negative deposit rates. Corporates have, are being charged negative 60, negative 70 bips. So, they're obviously reaching out to the bond market. Hence, that extra marginal demand and distribution of capital from all these players is very strong, and it absorbs all of the debt that's being unleashed from capital markets and investment banks.
Brian, there's people in this equity market who look in the equity market, look over to credit and say, looks okay over there, the coast is clear, things are good. Is that the right message to take from what's happening in credit?
Yes, broadly speaking, I think absolutely yes. There are so many high yield issuers now that are issuing at negative real yields. I mean, no one would have believed this a decade ago. So it's great for credit buyers. I mean, not great for the people holding the yields, but for people issuing. People need yield. It's a great place to fund at, which is great for equity markets, and it's self-perpetuating. So balance sheets are great. The Fed is helping. Growth is okay. It's not 21% anymore, but growth is okay. And central banks are not taking the punch bowl away. So in many ways, it's a self-fulfilling prophecy, and people made room for the bonds. They're going to come and go. There'll be indigestion at some point, but I think the world's going to digest supply in a way that continues at this pace for a while.
A lot of people come on a show like this and they talk about the easy money being made, and I often push back against it because I don't think there's ever easy money to be made. It's only ever in hindsight when we look back and say there was easy money to be made. You had to be in the market, and there's always a reason not to be in the market. And Francis, you wear two hats, the economist hat and the market hat as well. And I think the toughest point right now is to make the eco call and then make the right market call off the back of it, because I can guarantee you what the economy looks like next year. Let's say I've got a crystal ball and I can tell you all, and you could still make the wrong market call. How tough is it, Francis, right now?
It's real challenging, and the correlation coefficient on macro and econ changes over time. I actually think it's probably quite low right now, and macro relevance is maybe less relevant in the next few months. So we have to defer to guests, for example, like Brian and Zach on here. But even when you're wearing your asset allocator hat and you're looking at the credit space, if you need to generate those higher returns, 6-7%, you're getting a little bit more nervous in the equity market. Over to the credit space is where you may want to be allocating more of that risk. So this is a challenging environment in order to make those transfers of calls. Inflation is a very good example. A lot of people predicted 4.5% to 5% CPI data. They did not predict 1.3% on the US 10-year. So just being very aware of those technical factors is key.
So true, Francis. Such a great point. Zach, just let me throw in one more additional point. How comfortable are you ignoring what is taking place in China right now on the credit side, with the property developers, more specifically with the likes of Evergrande?
Yeah. So there naturally has been some contagion within the Chinese high yield market and within the property market. But I would like to obviously make the point that there are exciting opportunities in Chinese property. However, the caveat, you need a deep analyst team who have the ability, probably a local presence in Hong Kong, seeing China, to actually sift through the various bond documentation and really understand the local political situation and the on and offshore market. If you do have those capabilities, your organization, there's good opportunities. What we will take as a positive is, the BB and certainly the BBB part of the Chinese property market has been reasonably strong. It did lose some performance last month or 6 weeks ago. It certainly pulled some back. And we are seeing, marginal buyers for even some of the higher quality single Bs. So it's a stock pickers market. The contagion hasn't really gone significantly outside of China. John, what other market is there in the world where you can get 10%, 15% double-digit yields for a BB rated security that might not necessarily be on a negative outlook?
Zach, out of interest, why do you think it hasn't spread beyond high yield in China from EM to DM?
Yeah, I think there's two reasons. First of all, we didn't see much contagion from any EM stories over the last couple of years into DM. I think the second reason is that there hasn't been significant capital flight out of China. We're not aware of significant capital flights, and that's from whether it's Western investors who, I'm talking about their credit here in particular. There hasn't been this, we haven't seen this occurring yet, and so therefore there hasn't been this forced selling, which often can cause contagion into other sectors.
Zach Swabe, sticking with us alongside Brian Weinstein and Francis Donald. We'll continue this conversation about what's happening globally and domestically. Still ahead, the final spread. A huge slate of data next week, stateside, domestically speaking, CPI and retail sales as well. From New York, this is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up over the next week, a ton to get your teeth into. The US Senate, of course, returning from summer recess on Monday. Then another read on inflation with US CPI out on Tuesday. Retail sales figures on Thursday. And finally, rounding out the week with the University of Michigan Consumer Sentiment Survey. Back with us, Francis Donald, Brian Weinstein, Zach Swabe. Francis, let's come straight to you. CPI, Tuesday. How long before the Fed has to sit there and say, maybe we're wrong?
Well, there are some seeds of it now, but I think they actually have a couple of months. And what will depend is not the headline, but what's underneath the surface. If the inflationary pressures are still coming from supply chain disruptions, still because of Delta, then they have more time. If they start to see that shelter inflation number start to rise and it's more broad-based and more on the demand side of the economy, then they will probably have to blink. And again, it has to do in conjunction with other data. If retail sales are also very soft and University of Michigan consumer confidence still looks, frankly, recessionary, they have more time. If the economic data accelerates at the same time, it's a bit harder.
Brian, same question to you.
I think the Fed's going to make up excuses to have more time. I think they're going to use the supply chain. I think we know about Delta. I think retail sales could be soft, and as we know, sentiment is falling. So I think the Fed is going to make up stories to fit their story, which is inflation is transitory. They want to be easy. They think they need to be easy. They've made the mistake before of going too quickly. They are not going to make it this time. So whether or not we believe it or the market believes it, I think the Fed needs to believe it. They'll tell their story, and they will stay dovish. Even though I think CPI will be sticky and we'll see signs of demand side inflation, it still could be explained for now as supply chain and Delta and other transitory
Brian,
things.
how does the market trade in an environment like that one? Away from redefining what transitory is, I'll see the same economic data and I'll see an easier Fed relative to the economic data. What does that mean?
I think steeper curves, and I think we're going to bring back, maybe not at the same fever pitch as we did in February, that reflationary trade. Maybe it's misdefined, maybe transitory is too, but I think the market wants to have the conversation again about is inflation sticky, are 1.3% 10-year notes too low? Again, that doesn't move them to 2.5, but it could easily move them back towards the top of the range.
I'd like to get to the final round, the rapid-fire round. 3 quick questions and 3 quick answers if we can. We have hardly discussed the European Central Bank. We mentioned President Lagarde maybe once briefly, just alluding to what's happening in Europe. Zach, I want to come to you first. Does Lagarde ever get to hike interest rates? Just a simple yes or no. Does President Lagarde ever get to hike interest rates? Yes or no, Zach?
No.
Brian?
No.
Francis?
No.
Isn't that just absolutely remarkable? Takes me to my next question. A hike from the Fed. 22, 23 or 24? 22, 23 or 24? Brian?
23.
Francis?
23, but late.
Zach?
I'll say 24.
OK, final question. I asked this one before. I ask it just to gauge where the panel is going, where my viewers are going, where the audience is going, and where my guests are going on this as well. What first, 1% or 2% on a US 10-year yield? Do we see 1% first or 2% first on a 10-year yield from where we are right now? Zach?
Based on my previous answer, 1%.
Francis?
Same, back to 1% before we can get to 2.
Brian?
2%.
Brian Weinstein, Zach Swabe, Francis Donald, fantastic to catch up with you all. Have a wonderful weekend, won't you? From New York City, this was Bloomberg Real Yield. I'll see you next Friday. This is Bloomberg TV.